Investing 101, a beginner's guide. Investing is often seen as a reliable pathway to achieving financial stability and growth. It involves allocating money into various financial vehicles with the potential for generating income or profit. For beginners, the world of investing can seem overwhelming, but understanding the basics is essential for making informed decisions. It is important to begin by defining clear financial goals and learning about different investment options, ranging from stocks and bonds to mutual funds and more. Before we continue, hit the subscribe button and notification bell for more videos like this. Embarking on the journey of investing requires careful consideration and planning. Beginners need to assess their financial situation, risk tolerance, and investment goals before diving in. It is vital to recognize that all investments come with risks and rewards, and creating a balanced portfolio that aligns with one's financial objectives is critical. There are resources available, such as financial literacy guides and investment advice for beginners, which can offer a wealth of knowledge to ease the initial apprehension and set the foundation for a strong investing approach. Even those with limited capital can start investing, with options available that can cater to various budget sizes. Starting early with whatever amount one is comfortable with can take advantage of compounding interest, potentially leading to significant growth over time. It is also crucial to recognize the importance of ongoing education and keeping abreast of financial news to manage one's investments effectively. Understanding investment basics. Before diving into the world of investing, it's essential to grasp the fundamental concepts that will guide investors in making informed decisions, from choosing the right types of investments to understanding the importance of diversification and risk management. Types of investments. Investors can choose from a wide array of investment vehicles. Stocks represent shares in the ownership of a company and can provide dividends as well as the potential for capital growth. Bonds are a form of loan to a corporation or government with periodic interest payments and the return of principal at maturity. Mutual funds and index funds allow investors to pool their money to invest in a diversified portfolio managed by professionals or tied to a specific market index, respectively. For those seeking an alternative to individual stock and bond picking, exchange-traded funds, ETFs, offer a blend of diversification and liquidity. 1. Stocks, potential for high returns through capital growth and dividends. 2. Bonds, steady income through interest payments, generally lower risk than stocks. 3. Mutual funds, professional management and diversification. Fees can vary. 4. Index funds, track specific market indexes, typically lower fees than mutual funds. 5. ETFs, trade like stocks, offer diversification and lower fees. Setting investment goals. Investing should begin with clear financial goals. Whether saving for retirement, a home, or education, these objectives will determine an individual's asset allocation and time horizon. A portfolio reflective of one's goals will incorporate a mix of asset classes aimed at achieving desired outcomes. For long-term goals, embracing compounding can significantly impact growth potential. 1. Short-term goals may prioritize stability and liquidity, might include more bonds and money market funds. 2. Long-term goals can aim for growth, leveraging the power of compounding, usually weighted towards stocks and growth stocks. Risk management basics. Effective risk management starts with assessing one's risk tolerance and time horizon to establish a suitable asset allocation. Diversification across various asset classes like stocks, bonds, real estate, and commodities can mitigate risk. Investors should be aware of inflation risk, where the buying power of investment returns may not keep pace with the cost of living increases. Ensuring a mix of investments that can hedge against inflation, such as real estate or inflation-protected securities, is crucial. 1. Risk tolerance. High tolerance may lead to a greater allocation in stocks and real estate. Low tolerance favors bonds and stable funds. 2. Diversification. Essential for spreading risk, include a mix of asset classes and sectors. 3. Inflation risk. Combat with assets known for inflation resilience, like certain types of bonds or real estate investments. Getting started with investing. Before embarking on the investment journey, it is important for individuals to choose the right investment account. Understand how to build a diversified portfolio and explore different investment strategies and management options to align with their financial goals. Choosing the right investment account. When looking to invest, one must consider the various types of accounts available. A brokerage account allows individuals to buy and sell securities like stocks, bonds, and mutual funds. For retirement planning, one might opt for tax-advantaged accounts such as a 401k, often with an employer match, a traditional IRA, or a Roth IRA, each with distinct tax implications. Education savings accounts can be beneficial for future tuition costs, while online savings accounts and certificates of deposit might suit shorter-term financial needs. It's critical to assess one's financial situation and investment goals before deciding, and consider using investing apps like E-Trade, Stash, or Acorns to start with small amounts of money and low fees. Building a diversified portfolio. Diversification is essential for balancing the risk and return in a portfolio. Investors should allocate their money across different asset classes, such as stocks, bonds, and exchange-traded funds, ETFs, to reduce risk. Incorporating a mixture of actively managed mutual funds and funds that track a market index can provide both growth potential and stability. For those who prefer a passive approach to investment, index funds and ETFs generally offer lower expense ratios than actively managed funds. Robo-advisors employ computer algorithms for efficient portfolio management, which can be an effective option for those with a smaller budget or lacking the time and expertise to manage their investments manually. Investment strategies and management. The choice of investment strategy should reflect one's tolerance for risk, investment goal, and time horizon. A long-term wealth-building approach often involves investing in stocks and mutual funds with the potential for growth, while short-term goals might lead to more conservative choices like bonds or high-interest saving accounts. Investors must be aware of their financial situation and avoid high-risk options if they are currently repaying high-interest debt. Money management services, either through a traditional brokerage firm like Charles Schwab or modern investing apps, can guide strategic asset allocation and investment choices to match an individual's unique circumstances. Investors should also keep in mind the expense ratios of any chosen funds, as these can significantly affect returns, especially in the case of a long-term investment horizon. Thank you for watching.